Prime. My name is Alex Matthew. We're dealing with an acquisition in the automotive ancillary space, and in fact, the company that we're talking about is Samvardhana Motherson International, which through its subsidiary, Samvardhana Motherson Automotive Systems, has acquired the automotive interior business of Dr Schneider Group and also certain subsidiaries of that group. To talk about the contours of that deal, and to give us an understanding as to how this will benefit Motherson down the line, I have with me Kunal Malani, who is the Chief Financial Officer of the Motherson Group. Thanks, Kunal, for taking the time. Just break down the contours of the deal. First of all, what are the assets that you're acquiring? And this is through an insolvency process, I'm given to understand.
Yes, thanks, Alex, for having us on the show. You're right. We'll be buying this from insolvency. At around about 0.5 times asset to book value to EV that is being paid. The EV is around 118 odd million. We expect the equity check to be somewhere in the 70 to 80 million levels. Carry a potential maximum amount of financial debt of around about 20 odd million only. The rest would be all adjustments on account of working capital or other related elements on debt-like side. So that's what we are expecting. It has a turnover of currently of 470 odd million, and an order book of around about 1.6 billion, which has to be executed over the next 3 years. So all in all, a very interesting asset, which is a testimony again of the customer trusting us. It is an insolvent asset that the customer handpicked us again to look at it and try and find a solution. The customer is supporting us in both, what we have to do for the turnaround of the asset as well as towards the restructuring of the asset. If you look at the history, actually, the business has been fairly profitable back in 17-18. It was having nearly 40 odd million of EBITDA. And then as COVID came in and, the supply chain bottlenecks and the financial leverage that the asset was carrying, it just couldn't come out of the restructuring. So hence, needed to find a better house like Motherson.
Interesting. Just a follow-up to that. The 20 million that you're talking about in terms of debt, is it the plan to keep it as it is right now, or are there any plans down the line to retire that?
In all likelihood, this will come for refinancing pretty much immediately. So I'm just saying the overall aggregate debt on books because of this is likely to be somewhere in the, let's say, 90 to 100 million odd levels. That's how we see the maximum debt in here. And, this should be a profitable business from day one, given our conversations with the customers around it. Plus, with their support, I think restructuring will hopefully be an easier game plan than what it was maybe for the existing management. And the customers will be actively involved in that restructuring, which is critical if you have to, do a product like this and move it across shores. And as I was saying, one of the issues with the asset is its high concentration in Europe. Again, in our portfolio and under the Motherson, set of assets, it has access to now 41 odd countries, and hence the ability to both move shores as well as to supply a lot more to newer set of customers. And given the IP protected, product lines that it has, aesthetic product lines that it has, it should be able to play towards the premiumization trend that is happening across the globe. And hence, we believe we'll be able to grow this business much faster than what the existing management was able to do.
So for those that are unfamiliar with what this company does that you're acquiring, or the business is, this is with regard to interiors of the car, but can you break down the key elements and the key companies the key OEMs that it supplies to?
So it actually does your aesthetic parts for the interior, stuff like air vents, the smaller parts, the air vents, some of the pillars, some of the finishes on the on the center consoles, on the cockpits and so on, which are all largely towards the high-end cars today. So your typical large 3 German OEMs would be the bigger set of the player that exists. and I think it has a fair amount of IPs both on the finish of these products, the method of manufacturing of these products, and so on. Which today, with their very European-centric manufacturing under our portfolio, we should be able to move this across to other shows as well as be able to supply to other customers. That's the basic thesis behind it. And with premiumization, the demand for some of these high-end products or better finished products is only growing. So we should be able to cater to that demand.
I see that there's 100% shares in subsidiaries in Spain, China, USA, and Poland. Does that mean that there is manufacturing capability in China, for example, and in the US?
That's right. So nearly 3/4 of the business is in Europe, between Spain, Poland, and Germany, Germany being the largest. And then Americas and China are the remaining 25% of the business approximately.
As I understand it, there was an attempt to restructure operations and finances. You pointed or you alluded to this point earlier. What didn't work, and what are you going to do differently in the next few months, where you're talking about the consummation of this in the third quarter? And how soon can you turn it around? You say that it's going to be EPS accretive from day one. How is that going to work?
Because I think, as if you look at the history, the asset was profitable then. As COVID hit, as some of the inflationary trends started playing out, obviously the current presence of the asset in its manufacturing part was obviously at a much higher cost destination. And hence their ability to compete with some of the other competitions was limited at one end. At the other end, I think it had high financial leverage. It was carrying a 200 million of debt in it, and hence its ability to restructure was fairly limited. Hence it needed a cleansing up to be done, which is what happened during the administration process. And then you required the customer to support who the new buyer would be, to be able to execute both the restructuring going ahead to make the asset more viable, as well as frankly add a lot more of customer base as well as production base that could come with a player like Motherson, which is present in 41 odd countries and serving pretty much every OEM on earth. So hence we fit in well from a solution perspective, and that's probably why the customers picked up for this asset.
Okay. 4,500 odd employees, if I'm not mistaken, and you've mentioned 200 plus patents. So all of that seems to be working right now. Will you have to change anything, or will you simply step in and ensure that things are going the right way? Will you have to infuse cash to bring things up to steam?
No, so actually not infuse cash. So do everything other than infuse cash. So there's a lot of operational work that has to happen for the restructuring to happen. The work has to happen on the engineering, being able to cater to newer customer base, and so on and so forth. So operationally, a lot of work has to happen to make sure that the asset starts delivering a higher growth trajectory as well as a better profitability construct going forward. But cash infusion, I think, largely is taken care of by customer support, whether in the form of price revisions or restructuring support and so on. So we don't expect cash infusion as such. But yeah, operationally, we need to do a lot of hard work to make sure the asset starts moving towards the 40% ROCE.
Okay. Last question in terms of once you take over. Will it be a gradual process of ramping up to full capacity? I'm trying to understand where things stand right now in terms of production capacity, utilization, etc. I'm sure you've already studied that.
Well, it will be a ramp up because, as I told you, it's got a 1.6 billion order book to be delivered over the next 3 years. So if you average it out, you're talking about around about 550 odd million from the current 470 odd level. So there is a ramp up to be had. And then the idea would be to add further from our portfolio of customers and our portfolio of reach that exists to be able to further add growth to it. Obviously, all of this would mean that we need to still make it profitable and do all this growth at a profitable level while working simultaneously towards restructuring the asset and making it much more commercially viable going forward and being able to compete better with other competition around the world. So that will be an endeavor. So I think for the next few years, we believe it should be profitable. And then the restructuring work has to make sure that it remains profitable going ahead as well.
So I'm asking you this before you've completed the acquisition. You've alluded to this, but a couple of years, by that you're saying this year and the next financial year, the year after that you turn profitable. Is that the expectation?
No. Look, I think obviously at the point of acquisition, you have got the support of the customers, which means you would be able to do this in a reasonably good way for the period that the current orders are there. As the newer orders start trickling in, those orders also have to be profitable. So customers can support their current set of orders, but they can't support future orders, obviously, which is coming under the Motherson name. And that Motherson has to ensure remains profitable. For which work has to happen, obviously, in terms of both the restructuring that has to go through, the operational improvements that has to go through, the reach which has to get expanded, maybe even the geographic base where we manufacture that, this needs to get expanded, which are all part of the plan as we move between now and, as I said, next couple of years.
So we'll touch base again on that. Thank you so much, Kunal, for joining in, for giving us the perspective that you did.
Thank you so much.
All right, viewers, there you have it. That was the management of Samvardhana Motherson International joining in. Thanks so much for watching. This is BQ Prime.